Alright everyone, I need your full attention because what I'm about to share could save your family hundreds of thousands of dollars. Here's the reality we're facing in 2025. Nursing home care now averages $9,500 per month nationally, while Medicaid still limits you to just $2,000 in assets to qualify for help. That means a typical middle-class family with $400,000 in savings faces complete financial devastation. But there's still hope if you understand the specific strategies I'm going to reveal today. I'll show you concrete steps families can take right now to protect their nest egg using legal asset protection methods and Medicaid planning techniques that actually work. The costs keep rising and the protection windows keep getting shorter, so we need to start with the numbers. The shocking reality of 2025 nursing home costs. Let me ask you something before we go any further. What do you think it costs per month for nursing home care in 2025? I want you to think about that for a second. Maybe you're thinking $5,000 a month. Maybe $6,000. Those numbers might seem high, but I need to tell you something that's going to shock you. The 2025 median cost for a semi-private room is $9,197 per month, while a private room runs $10,326 monthly. That's right, over $10,000 every single month for a private room. Now that number alone should make you sit up and pay attention, but it gets worse. Much worse. In high-cost areas like New York, California, Connecticut, and parts of Massachusetts, we're seeing nursing home costs that exceed $15,000 per month. Some facilities in Manhattan are charging over $18,000 monthly. Think about that for a moment. $18,000 every month just for a bed, meals, and basic care. The jump from where we were just 3 years ago is staggering. In 2022, the national average was around $8,200 monthly. That means we've seen an increase of over 15% in just 3 years. This isn't normal inflation we're talking about. This is a crisis that's hitting families across America and destroying life savings at record speed. What drove these massive increases? Two major factors created this situation. First, inflation hit every aspect of nursing home operations. Food costs went up, utility bills skyrocketed, insurance premiums increased, and maintenance costs for aging facilities climbed substantially. But the bigger driver has been the staffing shortage that began during the pandemic and never recovered. Nursing homes lost thousands of workers during COVID, and they haven't been able to replace them. The facilities that stayed open had to increase wages dramatically to keep staff and attract new workers. Many facilities now pay overtime rates just to maintain minimum staffing levels. Some are offering signing bonuses of $10,000 or more just to get certified nursing assistants in the door. All of these increased labor costs get passed directly to residents and their families. Here's something most people don't understand about Medicare coverage. Medicare only covers short-term skilled care up to 100 days, not long-term custodial care. Custodial care means help with daily activities like bathing, dressing, eating, and taking medications, which is what most people in nursing homes actually need. The reality is that most families are completely unprepared for these expenses. The Employee Benefit Research Institute found that only 23% of Americans have any long-term care insurance. That means 77% of families will pay these costs out of their own savings or rely on Medicaid if they qualify. Let me give you a real example of how quickly these costs destroy family wealth. Take a typical middle-class couple with $400,000 in retirement savings. The husband develops dementia and needs nursing home care at $9,500 per month. That's $114,000 per year. Even if the wife continues living at home with minimal expenses, their savings will be completely gone in less than 4 years. $400,000 gone. But remember, that's using the national average. In higher cost areas, that same family's savings disappear even faster. At $15,000 per month, we're talking about $180,000 per year. Their $400,000 lasts just over 2 years. 2 years and their life savings are completely wiped out. Here's another example that really drives home the reality. I worked with a family last year where the wife needed nursing home care for 6 years before she passed away. 6 years at an average cost of $10,200 per month. That's over $730,000 in nursing home expenses. They started with $850,000 in assets. By the time she passed, they had less than $50,000 left. The speed at which these costs consume savings catches families off guard every single day. Many people think they have enough money to last their lifetime, but they never calculated nursing home expenses into their retirement planning. A comfortable retirement of $5,000 per month in expenses suddenly becomes $14,500 per month when one spouse needs nursing home care. And the costs keep climbing every year. Industry projections show semi-private rooms will exceed $10,500 per month by 2030. Families planning for retirement need to factor in potential nursing home costs that could reach $20,000 per month in high-cost areas within the next decade. Most people assume they'll never need nursing home care, but the statistics tell a different story. The Department of Health and Human Services reports that 70% of Americans over age 65 will need some form of long-term care services. Of those, 35% will need nursing home care at some point. That's more than 1 in 3 people. The window for protecting assets from these costs is narrowing every year. Medicaid has strict rules about asset transfers, and any planning must be completed years before you need care. The longer families wait to implement protection strategies, the fewer options they have available. But here's what gives me hope and why I'm doing this presentation today. There are still legal methods that work to protect family wealth from these devastating costs. Families who understand these strategies and implement them properly can preserve their life savings even when nursing home care becomes necessary. The key is understanding that protection planning must happen before the crisis, not during it. Understanding these 2025 nursing home costs is your first step toward protecting your family's financial future. Once you grasp the magnitude of these expenses and how quickly they can destroy decades of savings, you can begin to appreciate why asset protection planning has become essential for every American family. The families who protect their wealth aren't the ones with the most money to start with. They're the ones who understand the threat and take action before it's too late. But knowing the costs is only half the battle. The bigger challenge most families face is understanding how government assistance actually works and why the qualification rules seem designed to trap middle-class families in an impossible situation. How Medicaid's 2025 rules create a wealth trap. Medicaid's asset counting rules create what I call a wealth trap that catches almost everyone off guard. Let's start with the basic asset limits for Medicaid eligibility in 2025. If you're single and applying for nursing home Medicaid, you can only keep $2,000 in countable assets. That's it. $2,000. Think about that for a moment. You could have worked for 40 years, saved diligently, built up a retirement account worth $300,000. And Medicaid says you need to spend down to just $2,000 before they'll help pay for your nursing home care. The rules get more complex when you're married. Medicaid recognizes that the healthy spouse staying at home needs resources to live on, so they created something called the Community Spouse Resource Allowance. In 2025, this allowance allows the healthy spouse to keep approximately $128,640 in countable assets. The exact calculation works like this. Medicaid takes 50% of the couple's total countable assets, and if that amount falls between $31,584 and $157,920, that's what the community spouse gets to keep. Here's an example that shows how this works in practice. Take a married couple with $400,000 in total assets. When the husband needs nursing home care and applies for Medicaid, they're allowed to keep $157,920 for the wife. The remaining $242,080 must be spent down before Medicaid will pay for the husband's care. At $9,500 per month for nursing home costs, that spend-down period lasts about 2 years. 2 years of paying privately while burning through their life savings. But the asset limits are just the beginning of Medicaid's wealth trap. The real trap comes from what's called the lookback period. Medicaid doesn't just look at what you own on the day you apply. They conduct a 5-year financial investigation into every transaction you've made. This 60-month look-back period means Medicaid reviews bank statements, investment account records, property transfers, and any gifts you've made going back 5 full years from your application date. Medicaid reviews 60 months of financial records for transfers over $1,000. Any gift, sale below market value, or transfer to trusts can trigger penalties. The penalty calculation works like this. Smaller amounts typically incur 1-month penalties per $5,000 transferred, while any gift over $300,000 triggers a 5-year penalty period. So if you gave your daughter $50,000 3 years ago to help with her house, you'd face a 10-month penalty period where you're responsible for paying the full nursing home costs even though you've already spent down your assets to qualify. I see families get caught by this all the time. A grandmother gives each of her 3 grandchildren $15,000 for their education. That's $45,000 in gifts. Later, when she needs nursing home care, those gifts create a penalty period that could last 9 months depending on local nursing home costs. The family thought they were being generous and helping with education expenses, but Medicaid treats those gifts as attempts to hide assets and imposes penalties. Property transfers create some of the biggest problems. Many families think they can transfer their house to their children and protect it from nursing home costs. But if you transfer your house during the look-back period without receiving fair market value, Medicaid calculates a penalty based on the home's value. A house worth $300,000 could trigger a penalty period lasting over 2 years in many areas. Here's what makes this particularly harsh. The penalties don't start until you would otherwise qualify for Medicaid. So you spend down all your countable assets to meet the $2,000 limit, apply for Medicaid, and then discover you face months or years of penalties during which you must pay privately for nursing home care. You're broke but still don't qualify for assistance. I worked with a family last year where this exact scenario played out. The parents had transferred their house to their son 4 years earlier thinking they were planning ahead. When the mother needed nursing home care, they spent down their savings to qualify for Medicaid. But the house transfer created an 18-month penalty period. The family had to come up with over $170,000 to pay for nursing home care during the penalty period. Money they didn't have because they'd already spent their savings. The all-or-nothing nature of Medicaid qualification makes planning extremely challenging. You either qualify completely or you don't qualify at all. There's no partial assistance, no sliding scale based on income or assets. You meet all the requirements or you pay privately until you do. What frustrates families most is that these rules seem designed to force people into poverty before providing assistance. You work your whole life, save responsibly, maybe help your children along the way, and then discover that normal family financial transactions disqualify you from the very program designed to help with long-term care costs. But here's the important point that gives me hope for families. There are legal strategies that work within these rules rather than against them. The key insight is understanding that Medicaid planning must happen before you need care, not during a crisis. Families who plan ahead using the right legal tools can protect their assets while still eventually qualifying for Medicaid when care becomes necessary. The rules create a trap for families who don't plan, but they also create opportunities for families who understand how to work within the system properly. The difference between families who lose everything and families who protect their wealth often comes down to timing and knowledge. 2 families with identical circumstances can have completely different outcomes based on whether they understood these rules and took action before the crisis hit. The 2-family story that changes everything. Let me tell you about 2 families that demonstrate exactly how these outcomes play out in real life. Both families had worked their entire careers, saved responsibly, and built up retirement assets worth about $700,000, including their homes. Both couples had similar incomes from Social Security and pensions, and both husbands developed dementia at age 78 requiring nursing home care. But what happened to these 2 families was completely different. The first family, Harold and Nancy, followed what most people would consider traditional financial planning advice. They kept their house in both their names, maintained their savings in joint bank accounts, and had their retirement accounts set up with each other as beneficiaries. When Harold started showing signs of dementia, Nancy became his caregiver at home for about 2 years. But eventually his condition deteriorated to the point where he needed professional nursing home care. Harold entered the nursing home when monthly costs were running about $8,400. Nancy continued living in their home, managing on her Social Security and Harold's pension. But every month, thousands of dollars came out of their joint savings to pay for Harold's care. Over the 3 years Harold lived in the nursing home, the family paid out $252,000 in care costs from their $400,000 savings account. Harold passed away, and Nancy thought the worst was behind her financially. But 6 months later, Nancy started having her own health issues. At age 82, she needed nursing home care herself. With their remaining savings depleted and facing monthly costs of over $9,000, Nancy had to apply for Medicaid assistance. When Nancy qualified for Medicaid, the state began paying for her nursing home care. But when Nancy passed away 2 years later, the state had spent approximately $300,000 on her Medicaid nursing home benefits. Under Medicaid estate recovery rules, the state filed a claim against Nancy's estate for the full amount they had paid for her care. The estate had to sell the family home to pay this claim. After real estate commissions and other estate settlement costs, Harold and Nancy's children inherited almost nothing from their parents' original $700,000 estate. Now let me tell you about the second family, Michael and Pamela, who had the same asset profile and similar circumstances. But 5 years before Michael developed dementia, when both were 70 years old and in good health, they made a decision that completely changed their family's financial future. Michael and Pamela learned about the risks of nursing home costs to family wealth and decided to meet with an elder law attorney who specialized in Medicaid planning. After reviewing their situation, the attorney recommended creating an irrevocable income-only trust. Michael and Pamela transferred their home and most of their savings into this specialized trust structure. They retained the right to receive all income generated by the trust assets, which meant they could still access interest, dividends, and any rental income. The trust was designed so that after 5 years, the assets would no longer count as available resources for Medicaid eligibility purposes. When Michael developed dementia at age 78, the family faced the same difficult decision about nursing home care. Michael entered a nursing home with monthly costs identical to Harold's situation. But here's where Michael and Pamela's advanced planning paid off dramatically. Because more than 5 years had passed since they created the trust, the assets inside the trust no longer counted for Medicaid eligibility. Michael qualified for Medicaid benefits immediately. The state began paying for his nursing home care from day one, and the family didn't have to spend down their life savings. Michael lived in the nursing home for 3 years, just like Harold. But instead of spending hundreds of thousands of dollars of their own money, Michael and Pamela's family paid nothing out of pocket for Michael's care. Medicaid covered 100% of the nursing home costs. When Michael passed away, Pamela was able to continue living in the family home because the trust allowed her to remain there for life. The trust assets that had been protected during Michael's nursing home stay remained intact for Pamela's use and security. Later, when Pamela developed her own health issues and needed nursing home care at age 82, she also qualified for immediate Medicaid coverage. The trust assets still didn't count as available resources because they remained properly structured within the irrevocable trust. When Pamela passed away after receiving Medicaid-covered nursing home care, there was no estate recovery claim against the family home or savings. The trust had protected these assets from being considered part of Pamela's countable estate for Medicaid purposes. Michael and Pamela's children inherited the full value of their parents' $700,000 estate. Think about this comparison for a moment. Both families started with identical assets and faced identical circumstances. Both husbands developed dementia at the same age and needed the same level of nursing home care for the same length of time. Both wives eventually needed nursing home care themselves. But Harold and Nancy, who kept everything in their own names following traditional advice, saw their entire life savings consumed by nursing home costs and Medicaid estate recovery. Their children inherited almost nothing. Michael and Pamela, who implemented protective planning 5 years before they needed care, preserved their full $700,000 estate for their children while receiving the same quality nursing home care covered by Medicaid. The difference wasn't luck, income levels, or investment performance. The difference was understanding how Medicaid's rules work and taking legal action to protect their assets before a health crisis occurred. Michael and Pamela gave up direct ownership of their assets but retained beneficial use through the trust structure. This strategic sacrifice of ownership allowed them to preserve their family's wealth while ensuring they would qualify for Medicaid benefits when long-term care became necessary. This story illustrates why most families struggle with asset protection planning. They assume that standard estate planning tools will protect them from nursing home costs, but those traditional approaches often fail completely when long-term care becomes necessary. Why traditional estate planning fails for long-term care? The most common mistake I see involves families who think their existing estate planning already protects them. People come to me saying they have their revocable living trust set up, everything's organized, and they believe they're protected from nursing home costs. But revocable trusts don't shield assets from Medicaid because you retain control. The 2025 limit is still $2,000, even if assets are in a revocable trust. The misconception about revocable living trusts creates enormous problems for families. They spend thousands of dollars setting up these trusts thinking they've protected their assets, but revocable trusts serve completely different purposes. The primary benefit of a revocable living trust is avoiding probate when you die and making asset transfers easier for your beneficiaries. But because you retain complete control over the trust assets during your lifetime, Medicaid treats those assets exactly the same as if you own them directly. Here's how this works in practice. Say you have $300,000 in a revocable living trust. When you apply for Medicaid nursing home benefits, the caseworker counts that entire $300,000 as an available resource. It doesn't matter that the money is technically owned by the trust. Since you can revoke the trust at any time, withdraw money whenever you want, and change beneficiaries without anyone's permission, Medicaid considers you the true owner of those assets. Harold and Nancy discovered this reality when Harold needed nursing home care. They had established a revocable living trust years earlier and transferred their house and savings into it, believing this provided protection. When Harold entered the nursing home, they learned they'd have to spend down almost all their trust assets before qualifying for Medicaid. The trust provided no protection whatsoever against nursing home costs, and their $700,000 estate was consumed by care expenses and eventual Medicaid estate recovery. Joint ownership creates similar problems that catch families off guard. Many couples think that putting assets in both names provides some protection, but Medicaid has specific rules about jointly owned property. When a married couple applies for nursing home Medicaid, all countable assets are considered jointly owned regardless of whose name appears on the accounts. Both spouses have equal ownership rights to everything, and the assets get counted toward the couple's total when determining Medicaid eligibility. Beneficiary designations don't help either. Some families think they can protect retirement accounts by naming their children as beneficiaries, but Medicaid looks at who controls the account during the owner's lifetime. If you can withdraw money from your IRA or 401k account, those assets count as available resources for Medicaid purposes. The fact that your children will inherit the account after your death doesn't change how Medicaid treats it while you're alive. This creates what I call the control versus protection dilemma that every family faces. Traditional estate planning focuses on maintaining control over your assets while you're alive and ensuring smooth transfers after death. But Medicaid planning requires the opposite approach. To protect assets from nursing home costs, you typically need to give up direct ownership and control over those assets. The timing of asset transfers makes this dilemma even more challenging. Families who try to protect assets after a health crisis has already begun face severe penalties under Medicaid's lookback rules. Any transfer of assets for less than fair market value during the 5 years before applying for Medicaid can trigger penalty periods where you're ineligible for benefits. I see this constantly with families who panic when one spouse receives a dementia diagnosis. They rush to transfer their house to their children or move money into their kids' accounts, thinking they're protecting assets. But these last-minute transfers actually make their situation worse. The transfers don't provide protection because they happen during the look-back period, and they create penalty periods that force the family to pay privately for nursing home care even after they've given away their assets. Gift-giving strategies that work perfectly for tax planning often create disasters for Medicaid planning. The IRS allows annual exclusion gifts of up to $19,000 per person in 2025 without triggering gift tax consequences. Many families think these tax-free gifts are also invisible to Medicaid, but that's completely wrong. Medicaid doesn't recognize the annual exclusion. Every gift during the 5-year look-back period, regardless of amount, gets counted when calculating penalty periods. Grandparents get caught by this rule constantly. They help grandchildren with college expenses, thinking the educational gifts are somehow exempt. They contribute to wedding costs, help with house down payments, or give money for special occasions. All of these gifts, despite being perfectly legal and often tax-advantaged, can disqualify the grandparents from Medicaid benefits years later when they need nursing home care. Charitable giving creates similar problems. Regular donations to churches, charities, or other organizations count as transfers for less than fair market value under Medicaid rules. A couple who donates $5,000 annually to their church could face a penalty period if they need Medicaid within 5 years of making those donations. The complexity of Medicaid's asset counting rules goes far beyond what most people expect. Joint bank accounts, CDs held in trust for grandchildren, prepaid funeral contracts, life insurance policies with cash value, and even personal property over certain dollar amounts all get evaluated under different rules. Small mistakes in how assets are titled or structured can have enormous consequences years later. The fundamental problem is that traditional estate planning tools weren't designed for today's long-term care cost crisis. When revocable living trusts became popular decades ago, nursing home care cost a fraction of what it costs today, and Medicaid had much simpler eligibility rules. The legal tools that work for probate avoidance, tax planning, and basic asset transfers simply don't address the specific challenges of protecting wealth from nursing home costs. Effective protection from nursing home costs requires specialized trust structures designed specifically for Medicaid planning rather than traditional estate planning tools that focus on maintaining control and flexibility. But understanding asset protection is only part of the equation. Most families also get surprised by how Medicaid handles income during nursing home care, which creates additional planning opportunities they never knew existed.
On the asset limits and spend-down requirements, but they completely overlook how Medicaid handles income during nursing home care. The income rules work completely differently than the asset rules, and understanding these differences can save families thousands of dollars every month. Let me start with a question that stumps most people. What do you think happens to your Social Security check and pension payments when you enter a nursing home and qualify for Medicaid? Many people assume Medicaid takes over all the payments and the resident loses access to their income entirely. Others think the income gets added to their countable assets and affects their eligibility. Both assumptions are wrong, and the real answer reveals opportunities that most families miss completely. Social Security and pension income don't count toward asset limits for Medicaid eligibility purposes. This means your monthly Social Security check doesn't get added to your $2,000 asset limit. Your pension doesn't count toward the Community Spouse Resource Allowance either. Income and assets are treated as completely separate categories under Medicaid rules, and income allocation follows the name on the check rule, where income belongs to whoever's name appears on the payment. But here's where it gets interesting for married couples. When one spouse needs nursing home care and the other spouse remains living at home, Medicaid has specific rules about how much income the community spouse gets to keep. In 2025, the community spouse monthly maintenance needs allowance starts at $3,216 per month. This represents the minimum amount Medicaid believes the healthy spouse needs to cover basic living expenses while remaining in the community. Let me walk through a typical example to show how this works in practice. Take a married couple where the husband enters a nursing home and the wife continues living at home. The wife receives $1,200 monthly from Social Security in her own name. The husband receives $1,800 monthly from Social Security, plus a $1,500 pension, both in his name. The wife's total monthly income is $1,200, while the husband's total monthly income is $3,300. Since the wife's income of $1,200 falls below the minimum maintenance needs allowance of $3,216, she's entitled to keep enough of her husband's income to reach that minimum threshold. The calculation works like this. $3,216 minus $1,200 equals $2,016. So the wife can keep $2,016 of her husband's monthly income, bringing her total monthly income up to the minimum allowance of $3,216. This leaves the husband with $1,284 of his original $3,300 monthly income. But Medicaid doesn't let the nursing home resident keep all of this remaining income. Most states allow nursing home residents to keep a small personal needs allowance, typically between $30 and $100 monthly for personal expenses like haircuts, clothing, or small purchases. The remaining income goes directly toward the nursing home costs. In our example, if the state allows a $60 monthly personal needs allowance, the husband keeps $60 and the remaining $1,224 goes toward his nursing home expenses. Since the nursing home costs $9,500 monthly and Medicaid pays the difference after applying the resident's income, Medicaid would pay $8,276 monthly toward the nursing home costs. The income rules become more favorable for couples when the community spouse has higher maintenance needs. Medicaid recognizes that some spouses may need more than the minimum allowance to cover their living expenses. The maximum monthly maintenance needs allowance for 2025 is $3,948. If the community spouse can demonstrate higher shelter costs, utility expenses, or other necessary living costs, they may be entitled to keep more of the nursing home spouse's income. Here's where strategic planning can make a significant difference. Take the same couple from our earlier example, but assume the wife still has a mortgage payment, higher property taxes, and increased utility costs that total $3,500 monthly. Her basic living expenses exceed the minimum maintenance needs allowance. In this case, she might qualify for a higher income allowance, potentially keeping $3,500 monthly instead of $3,216. This higher allowance would allow her to keep $2,300 of her husband's income instead of $2,016. The calculation becomes $3,500 minus. Her $1,200 Social Security equals $2,300 from her husband's income. This reduces the amount going toward nursing home costs and provides the wife with more financial security while her husband receives care. Retirement account distributions create additional complexity in income planning. When someone receives Medicaid nursing home benefits, any distributions from IRAs, 401k accounts, or other retirement plans count as income in the month received. This means families need to carefully time retirement account withdrawals to optimize income allocation between spouses. I worked with a family where the wife was planning to take a large IRA distribution to pay for home improvements just before her husband entered a nursing home. We restructured the timing so she took smaller monthly distributions that stayed within the maintenance needs allowance rather than one large distribution that would have gone entirely toward nursing home costs. This strategy saved the family over $15,000 annually while still providing the wife with funds for necessary home maintenance. The income rules also affect how families handle Social Security optimization strategies. Some couples delay claiming Social Security to receive higher monthly benefits later. But when nursing home care becomes necessary, the timing of Social Security claims can affect how much income the community spouse retains versus how much goes toward care costs. Understanding how income and asset planning work together reveals the complete picture of Medicaid financial planning. While asset protection strategies focus on removing resources from Medicaid's reach, income planning focuses on legally optimizing how available income gets allocated between spouses. The key insight is that income planning can significantly reduce out-of-pocket nursing home expenses even when families haven't implemented advanced asset protection strategies. But income optimization alone can only do so much when you're facing nursing home costs that exceed $10,000 monthly. For families who want to preserve their life savings while ensuring Medicaid coverage, Income planning needs to work alongside asset protection strategies that actually remove wealth from Medicaid's counting rules entirely. Irrevocable trusts, the protection tool that actually works. The legal strategy that actually provides real protection from nursing home costs is an irrevocable trust specifically designed for Medicaid planning. After everything I've explained about how traditional estate planning tools fail and how Medicaid's rules create wealth traps, you need to understand the one approach that consistently works. These aren't your typical irrevocable trusts that people use for tax planning. We're talking about specialized trust structures that remove assets completely from Medicaid's counting rules while still maintaining meaningful access for your family. The most effective version is what attorneys call an income-only trust, and when properly structured, it can protect 100% of your assets from nursing home costs. Let me give you a real example that demonstrates exactly how powerful this strategy can be. Remember Michael and Pamela from our earlier story? They had $700,000 in assets and faced the same nursing home crisis as Harold and Nancy. But Michael and Pamela transferred their assets to an irrevocable trust 5 years before Michael developed dementia. When he needed nursing home care, the trust assets didn't count for Medicaid eligibility, and they qualified for immediate coverage. The result? They saved their entire $700,000 estate while receiving the same quality care that consumed Harold and Nancy's wealth completely. Here's how the protection works. When you transfer assets into a properly drafted irrevocable trust, those assets are no longer considered yours for Medicaid eligibility purposes. Medicaid looks at legal ownership, not beneficial interest. Since the trust legally owns the assets, and you can't simply revoke the trust and take the money back, Medicaid treats those assets as unavailable resources that don't count toward the asset limits. The income-only feature addresses the biggest concern most families have about giving up control of their assets. While you transfer ownership of the principal to the trust, you retain the right to receive all income generated by those assets for the rest of your life. This means if you put $500,000 into the trust and it earns 3% annually, you continue receiving $15,000 in annual income. You get the money you need for living expenses while protecting the underlying assets from nursing home costs. The structure is straightforward. The trustee manages assets, beneficiaries get the remainder after your death, and you keep income only. Once 5 years pass, the assets become non-countable for Medicaid purposes. This simplicity makes the trust effective while avoiding the complexity that often derails other planning strategies. The 5-year seasoning period is absolutely critical to understand because timing determines whether the protection works or fails completely. Medicaid's lookback rules mean any assets transferred to an irrevocable trust within 5 years of applying for benefits could trigger penalty periods. This means you need to complete your trust planning at least 5 years before you anticipate needing nursing home care. Most families who implement these trusts are in their late 60s or early 70s when they're still healthy but starting to think seriously about long-term care possibilities. You can't predict with certainty when you'll need care, but you can plan based on reasonable life expectancy and family health history. Let me share another successful example that shows how this works in practice. The Patterson family came to see me when both spouses were 72 and in good health. They had $750,000 in retirement savings plus a home worth $400,000. We created an income-only trust and transferred $600,000 of their savings plus their home into the trust structure. The trust generated about $18,000 annually in income that the Pattersons continued receiving. They kept $150,000 outside the trust for liquidity and emergencies. 7 years later, when Mr. Patterson developed Alzheimer's and needed nursing home care, the family qualified for immediate Medicaid coverage because the trust assets didn't count toward their eligibility calculation. The trust protected $1 million in total assets, while Mr. Patterson received 3 years of Medicaid-covered nursing home care. When he passed away, Mrs. Patterson continued living in the home and receiving the trust income. The family preserved their entire life savings while receiving quality long-term care covered by Medicaid. Home protection through these trusts works differently than protecting financial assets, but achieves the same result. When you transfer your house to an income-only trust, you typically retain the right to live there for life. The trust owns the property legally, so it doesn't count as an available resource for Medicaid. When you eventually need nursing home care, Medicaid can't force the sale of a home you don't legally own. The trust also protects your home from Medicaid estate recovery after death. Since the home belongs to the trust rather than your individual estate, state Medicaid programs can't file claims against the property to recover benefits they paid during your lifetime. Your children inherit the home through the trust without Medicaid interference. Savings protection works through the same legal principle, but offers more ongoing access through income payments. Investment accounts, CDs, savings accounts, and other financial assets transferred to the trust generate income you can receive while the principal stays protected. The trust can sell investments and reinvest proceeds, but the trustee manages these decisions according to the trust terms rather than your direct control. Control issues represent the biggest psychological hurdle for most families considering these trusts. You're giving up the ability to spend principal on whatever you want whenever you want. You can't simply close the trust and take a vacation to Europe with the money. The trustee makes decisions about principal distributions, and those decisions must follow the trust documents guidelines. But successful families manage these control concerns by choosing trustees they trust completely, usually adult children who understand the family's values and needs. They draft trust terms that give trustees reasonable discretion to handle emergencies and special circumstances. They recognize that some loss of control is the price for protecting their life's work from nursing home costs. The key insight is that properly structured irrevocable trusts can protect 100% of transferred assets while maintaining meaningful family access through income payments and trustee distributions. These trusts remove assets from Medicaid's reach completely while ensuring your family benefits from your life savings both during your lifetime and after your death. Understanding how these trusts work is essential. But there's another factor that can dramatically affect your planning success that most families never consider. State-by-state variations, you must know. That factor is geography. And the state-specific variations in Medicaid rules can literally save or cost your family tens of thousands of dollars. Most people assume Medicaid rules are the same everywhere across the United States, but that assumption couldn't be more wrong. Each state administers its own Medicaid program within federal guidelines, which means the specific regulations that determine your eligibility and asset protection opportunities can vary dramatically depending on where you live. The Community Spouse Resource Allowance provides a perfect example of how these state variations can impact your family's financial future. Remember earlier when I mentioned that the healthy spouse can keep approximately $128,640 in assets? That's actually just the midpoint of a range that varies significantly by state. In 2025, some states allow the community spouse to protect as little as $31,584, while other states permit asset protection up to $157,920. Think about what this means for two identical families living in different states. A couple in a low protection state might only shield $31,000 for the healthy spouse, forcing them to spend down an additional $126,000 before qualifying for Medicaid. Meanwhile, the same couple living in a high protection state could preserve the full $157,000. That's a difference of over $125,000 in protected assets based solely on geography. Home equity limits create even more dramatic variations between states. While most states impose home equity limits ranging from $730,000 to $1,097,000 in 2025, the actual limits vary widely. California stands out as unique because it has no home equity limit whatsoever for Medicaid eligibility purposes. A family with a $2 million home in California faces no eligibility issues related to home equity, while the same family in most other states would exceed the home equity limits and potentially face disqualification. The penalty period calculations also vary in ways that can significantly affect families caught by transfer violations. When Medicaid discovers improper asset transfers during the lookback period, they calculate penalty periods by dividing the transfer amount by the average monthly nursing home cost in that state. States with higher nursing home costs actually impose shorter penalty periods for identical transfers compared to states with lower costs. Here's a real example that illustrates this point. Say you transferred $50,000 to your children 3 years ago, and now you need nursing home Medicaid. In a state where nursing home care costs $8,000 monthly, this transfer creates a penalty period of 6.25 months. But in a state where nursing home costs $12,000 monthly, the same $50,000 transfer only creates a penalty period of about 4 months. The higher nursing home costs actually work in your favor by reducing the length of penalty periods. Some states have implemented enhanced spousal protection provisions that go beyond federal minimums. These states recognize that the basic community spouse protections might not adequately address the cost of living differences across regions. Enhanced protection states may offer higher income allowances for community spouses, increased asset protection thresholds, or more flexible rules about what constitutes necessary living expenses. Community property states and common law states create different planning opportunities. Community property states like California, Arizona, Nevada, New Mexico, Texas, Washington, Idaho, Wisconsin, and Louisiana treat all assets acquired during marriage as jointly owned by both spouses regardless of whose name appears on accounts or titles. This joint ownership typically allows for more flexible strategies to protect assets between spouses compared to common law states that determine ownership based on whose name appears on the asset. I've worked with families who move strategically to take advantage of more favorable state rules. The Henderson family lived in a state with relatively restrictive Medicaid provisions and high nursing home costs. When they reached their early 70s and started thinking seriously about long-term care planning, they researched states with more generous asset protection rules and lower living costs. They relocated to a state with higher community spouse resource allowances and no state income tax, improving their overall financial position for potential long-term care needs. However, strategic relocation requires careful consideration of residency requirements, potential impacts on existing estate plans, and the time needed to establish legal residency before applying for benefits. Most states require at least 12 months of legal residency before you can apply for Medicaid benefits, and some have longer requirements. You can't simply move to a favorable state and immediately apply for benefits. The importance of local expertise cannot be overstated when dealing with these state-specific variations. An elder law attorney practicing in your state understands not only the written regulations, but also how local Medicaid offices interpret and apply those rules in practice. Two states might have similar written rules, but completely different application processes or interpretive standards. Local attorneys also understand which strategies work effectively with specific state Medicaid offices and which approaches tend to create problems. They know the particular forms required, the documentation standards expected, and the typical timelines for application processing. This local knowledge can make the difference between successful asset protection and costly mistakes. State rules change periodically through legislative action or administrative updates. What worked in your state 5 years ago might not work today, and planning strategies that are effective now might not be available in the future. Local attorneys stay current with these changes and can adjust planning strategies accordingly. The application and appeals processes also vary significantly between states. Some states have streamlined application procedures with relatively quick processing times, while others have more complex requirements and longer waiting periods. Understanding your state-specific procedures helps families prepare properly and avoid delays that could result in additional months of private pay nursing home costs. Asset protection strategies that work well in one state might be less effective or even counterproductive in another state due to different interpretations of federal rules or state-specific regulations. For example, some states are more accepting of certain trust structures or gifting strategies, while others scrutinize these arrangements more closely. Your state-specific rules could literally save or cost your family thousands of dollars in long-term care expenses and asset protection opportunities. Understanding these variations isn't just academic curiosity. It's essential information that directly impacts your family's financial security and the effectiveness of your long-term care planning strategies. But even within these state variations, there's one asset that creates more anxiety and confusion for families
the home protection
than any other when it comes to protection
Mississippi.
planning. That asset is the family home, and the protection strategies available are more powerful than most people realize. For most families, their house represents their largest single asset and holds decades of memories. But it's also the asset they understand least when it comes to Medicaid planning. The rules around home protection are complex, full of misconceptions, and vary significantly depending on your specific circumstances. Most families believe their home is automatically protected from Medicaid because they've heard about something called the Homestead Exemption. This exemption does exist, but it works differently than most people think. The Homestead Exemption allows you to continue living in your home while receiving Medicaid benefits, but it doesn't protect the home from Medicaid estate recovery after your death. When you pass away, the state can file a claim against your estate to recover the money they spent on your long-term care, and your home often becomes the primary asset used to satisfy that claim. The home equity limits create another layer of complexity that catches families off guard. In 2025, if you're single and there's no spouse living in the home, most states impose a home equity interest limit of $730,000. Home equity means the value of your home minus any outstanding mortgage debt. If your home equity exceeds this limit, you won't qualify for Medicaid nursing home benefits until you reduce the equity below the threshold. California stands out as unique because it has no home equity limit whatsoever for Medicaid eligibility purposes, while other states maintain these restrictions. The protection strategies available to married couples differ significantly from those available to single individuals. When a married couple applies for nursing home Medicaid and one spouse continues living in the home, there's no home equity limit. The community spouse can live in a home worth any amount without affecting Medicaid eligibility. This represents a significant advantage for married couples compared to single applicants. But married couples face their own challenges when it comes to long-term home protection. The Homestead Exemption only lasts as long as the community spouse continues living in the home. When the community spouse dies or moves to a nursing home themselves, the home loses its protected status and becomes subject to Medicaid estate recovery. This means the children might ultimately lose the family home to satisfy Medicaid claims unless advanced planning protects it. Two key strategies can provide complete home protection when implemented properly: irrevocable trusts and life estate arrangements. Both approaches remove the home from Medicaid's asset calculations while allowing you to maintain beneficial use of the property. Life estate arrangements offer one solution that many families overlook completely. A life estate allows you to transfer ownership of your home to your children while retaining the legal right to live there for the rest of your life. You become the life tenant with the right to occupy the property, while your children become the remainder beneficiaries who will own the home outright after your death. The key advantage of life estates is that once the arrangement is properly established and the 5-year look-back period passes, the home no longer counts as your asset for Medicaid purposes. You've given away the ownership interest while keeping the right to live there. When you eventually need nursing home care and apply for Medicaid, the house doesn't count toward your asset limits because you don't legally own it anymore. Life estates also protect the home from Medicaid estate recovery because the property doesn't pass through your individual estate when you die. Since your children already owned the remainder interest, the state can't file claims against property that's not part of your estate. The home passes directly to your children without Medicaid interference. However, life estates require careful consideration of potential drawbacks. Once you create a life estate, you can't sell the home or obtain a mortgage without your children's consent and participation. If family relationships deteriorate or if your children face financial problems like divorce or bankruptcy, their ownership interest in your home could be affected. You also lose the ability to claim the full capital gains exclusion if you decide to sell the home later. The second major strategy involves transferring the home to an irrevocable trust designed specifically for Medicaid planning. These Medicaid asset protection trusts can provide more flexibility than life estates while achieving similar asset protection results. The trust owns the home legally, but you retain the right to live there and may have some input on future decisions about the property. The assets are managed by a trustee, and you can still benefit from the assets by remaining in your home. Trust-based home protection often works better for families who want more control over future decisions or who have complex family situations. Like life estates, the 5-year look-back period must pass before the trust provides protection from Medicaid's asset counting rules. Many families consider joint ownership with adult children as a simpler alternative to life estates, but this approach creates significant risks that often outweigh the benefits. When you add your children as joint owners of your home, they immediately acquire ownership rights and potential liabilities. If your child gets divorced, faces a lawsuit, or declares bankruptcy, their ownership interest in your home could be at risk. Joint ownership also triggers potential gift tax consequences when you add children to the deed. The IRS treats this as a partial gift of a home's value, which might require filing gift tax returns and could affect your lifetime gift tax exemption. Additionally, your children lose the stepped-up tax basis they would receive if they inherited the home after your death, potentially creating higher capital gains taxes when they eventually sell the property. I worked with the Morrison family who successfully protected their home using a life estate strategy. The parents owned a home worth $450,000 when they were both 74 and in good health. We created a life estate that allowed them to continue living in the home while transferring ownership to their 3 children. 6 years later, when Mrs. Morrison needed nursing home care, the home didn't count as an available asset because the life estate had been in place longer than the 5-year look-back period. The family qualified for immediate Medicaid coverage while preserving the home for the children. Home protection planning fits into your overall asset protection strategy by addressing your largest single asset while coordinating with protection of financial assets. Many families implement comprehensive plans that protect both their home and savings using complementary strategies. The home might go into a life estate or trust arrangement while retirement savings get protected through different trust structures. One of the biggest misconceptions I encounter is the belief that homes are automatically protected simply because someone lives there. Families assume that primary residences can't be touched by Medicaid, but this assumption ignores the estate recovery process that occurs after death. While you might keep your home during your lifetime, the state can still claim it after you pass away to recover long-term care costs. The family home can be completely protected with the right advance planning, but protection requires understanding the specific rules that apply to your situation and implementing appropriate strategies before you need care. Both irrevocable trusts and life estates require the 5-year look-back period to pass before providing protection, which means families need to act while they're still healthy and planning ahead. But what happens when families don't have 5 years to plan ahead? What options exist when the health crisis has already begun and time is running short? Crisis planning. What to do when time is short. I know some of you watching this are thinking this is all great information, but what if it's too late for advanced planning? What if your spouse is already showing signs of dementia, or maybe they've already been diagnosed and you're looking at nursing home care in the next few months? The reality is that some families find themselves in crisis situations where they need immediate help. And while your options are much more limited than they would be with advanced planning, there are still legal strategies available to preserve some family wealth even when time is running short. Let me be honest with you about what happens when you're in crisis planning mode. The 5-year look-back period becomes your biggest enemy because any significant asset transfers you make now will likely trigger penalty periods when you apply for Medicaid. This means you can't simply give money to your children or transfer your house to them without facing months or even years of Medicaid ineligibility. The ideal planning window has closed, but that doesn't mean you're completely out of options. The first strategy available in crisis situations is what we call legal spend-down methods. These involve using your assets to pay for legitimate expenses that Medicaid considers acceptable ways to reduce your countable resources. The key is that these expenditures must be for goods or services that provide fair market value in return, so Medicaid doesn't treat them as improper transfers that trigger penalties. Medical expenses represent the most straightforward spend-down opportunity. You can pay for health insurance premiums, prescription medications, medical equipment like wheelchairs, or hospital beds, outstanding medical bills, dental work that's been postponed, hearing aids, eyeglasses, and any other legitimate healthcare costs. These payments reduce your assets while purchasing necessary medical care, making them completely acceptable to Medicaid. Home modifications often provide excellent spend-down opportunities while improving safety and accessibility. Installing wheelchair ramps, widening doorways, adding grab bars in bathrooms, replacing regular bathtubs with walk-in showers, improving lighting throughout the house, and adding stair lifts all count as legitimate medical expenses. These modifications not only reduce countable assets, but also might allow someone to remain at home longer before needing nursing home care. Medicaid-compliant annuities offer a more sophisticated crisis planning tool, but they must be structured very carefully to comply with Medicaid rules. A Medicaid-compliant annuity converts a lump sum of cash into a stream of monthly income payments. The annuity must be irrevocable, non-transferable, and actuarially sound, meaning the payment period cannot exceed your life expectancy based on Social Security Administration tables. The annuity strategy works particularly well for married couples where the community spouse can purchase an annuity with excess assets. The monthly annuity payments become income for the community spouse, potentially increasing their monthly maintenance allowance while removing the principal from Medicaid's asset calculations. However, these annuities must name the state Medicaid program as a beneficiary, which means if you die before receiving all payments, the remaining balance goes to the state rather than your family. Caregiver agreements represent another crisis planning option that many families overlook. These are legally binding contracts where you pay a family member or friend to provide personal care services. The payments must be for care provided after the agreement is signed, and the compensation must reflect fair market value for the services provided. This strategy allows you to spend down excess assets by paying for needed care while keeping the money within your family. A proper caregiver agreement requires detailed documentation of the services provided, regular payment schedules, and rates that match what you would pay professional caregivers in your area. The caregiver must report this income on their tax returns, and the agreement should specify exactly what care services will be provided, from assistance with daily activities to transportation to medical appointments. Prepaid funeral trusts offer another spend-down opportunity that families often forget about. You can prepay funeral expenses for yourself and your spouse without these payments counting as improper transfers. Many funeral homes offer irrevocable funeral trusts that allow you to pay in advance for funeral services and burial expenses, removing these funds from your countable assets while ensuring your final arrangements are handled according to your wishes. Paying off existing debts represents another acceptable spend-down strategy. Outstanding credit card balances, personal loans, car loans, or even mortgage payments can be paid off using excess assets without violating Medicaid's transfer rules. The key is that these must be legitimate debts that you're legally obligated to pay, not informal arrangements with family members. The importance of professional guidance cannot be overstated when you're in crisis planning mode. Elder law attorneys who specialize in Medicaid planning understand the intricate rules and can help you navigate the limited options available. They can also help you avoid costly mistakes that could make your situation worse rather than better. What makes crisis planning particularly challenging is that you're operating under extreme time pressure while dealing with complex legal and financial rules. Families often feel overwhelmed by the immediate need for care while simultaneously trying to understand complicated asset protection strategies. Professional guidance helps ensure that whatever strategies you implement actually work within Medicaid's requirements and don't inadvertently create additional problems. The key takeaway is that even in crisis situations, there are legal strategies available to preserve some family wealth. While you can't achieve the comprehensive asset protection that's possible with advanced planning, you can still make strategic decisions that save your family thousands of dollars. Crisis planning requires quick action, careful implementation, and professional guidance, but it can provide meaningful financial protection even when time is running short. But whether you're planning ahead or dealing with an immediate crisis, the most important step is taking action rather than hoping the problem will somehow resolve itself. Taking action, your step-by-step protection plan. The comprehensive protection plan I'm about to outline will help you implement these strategies effectively and preserve your family's financial security. Every family situation is unique, but the fundamental steps remain consistent regardless of your asset levels or current circumstances. The first critical step involves conducting a comprehensive assessment of your current vulnerability to nursing home costs. You need to calculate your total countable assets for Medicaid purposes, which includes all bank accounts, investment accounts, retirement accounts, CDs, savings bonds, and any other financial assets that Medicaid considers available resources. Don't include your primary residence, one vehicle, personal belongings, or prepaid funeral arrangements in this calculation. The number you arrive at represents what's at risk if you need nursing home care without advanced planning. Research the actual nursing home costs in your specific area by calling several facilities near you and asking about their private pay rates for the level of care you might need. Don't rely on national averages because costs vary dramatically by location. A nursing home that charges $8,000 monthly creates different planning urgency than one charging $15,000 monthly. Consider your family health history and current health status to estimate your potential need for long-term care. If your parents or siblings require nursing home care, if you have chronic health conditions, or if you're already experiencing mobility or cognitive issues, your planning timeline becomes more critical. Remember that 70% of Americans over 65 will need some form of long-term care services. So planning isn't just for families with obvious health risks. The second essential step requires gathering comprehensive documentation that supports both protection planning and eventual Medicaid applications. You need 5 years of bank statements for all accounts, 5 years of investment account statements, 5 years of tax returns, documentation of any property transfers or gifts during the past 5 years, current property deeds and titles, insurance policies including life insurance and long-term care coverage, and documentation of any trusts or other estate planning documents you currently have. This documentation process often reveals financial transactions that families forgot about, but that could create problems under Medicaid's lookback rules. Large withdrawals, transfers between accounts, gifts to family members, charitable donations, and other transactions all need to be documented and explained. Many families discover they made transfers during the look-back period that could trigger penalty periods if they don't implement corrective planning strategies. The third and most important step involves consulting with an elder law attorney who specializes in Medicaid planning rather than attempting to navigate these complex rules on your own. The investment required for professional planning varies based on your asset levels and the complexity of strategies you implement. Basic Medicaid planning consultations typically cost between $500 and $1,500. Simple trust planning might range from $3,000 to $8,000. Complex planning involving multiple trusts, property transfers, and ongoing management could cost $10,000 to $20,000 or more. However, these planning costs represent a fraction of what nursing home care costs over just a few months. If professional planning saves your family even 6 months of private pay nursing home costs, the investment pays for itself many times over. Families who spend $15,000 on comprehensive protection planning often preserve hundreds of thousands of dollars in assets. The timeline for implementing protection strategies depends on which tools you choose and how much lead time you have before potentially needing care. Irrevocable trusts require the full 5-year seasoning period to remove assets from Medicaid's reach. so families typically implement these strategies in their late 60s or early 70s while they're still healthy. Life estate arrangements for home protection also require the 5-year look-back period, but can be established relatively quickly once you decide to proceed. Family communication represents one of the most critical aspects of successful protection planning. Your adult children need to understand why you're considering these strategies, what role they might play as trustees or beneficiaries, and how the planning affects their eventual inheritance. Start these conversations early and focus on education rather than immediate decisions. Address concerns about control, access to money, and family fairness directly. The ongoing maintenance requirements for protection plans vary depending on which strategies you implement, but all effective planning requires some level of ongoing attention. Plan for annual meetings with your elder law attorney to review your protection strategies, update documentation, and adjust for any changes in your circumstances or in Medicaid rules. These reviews typically cost a few $100s annually, but ensure your planning remains effective and compliant with current regulations. Most families find that protection planning is achievable regardless of their asset levels. You don't need to be wealthy to benefit from these strategies. Families with $200,000 in assets benefit just as much as families with $2 million. The strategies scale to your situation, and the peace of mind benefits apply regardless of your wealth level. The peace of mind that comes from proper planning extends beyond just financial security. Knowing you have a plan in place reduces anxiety about the future, improves family relationships by eliminating uncertainty about care and inheritance, and allows you to focus on enjoying your retirement years rather than worrying about potential financial disasters. Here's what I want you to do right now. Schedule a free initial consultation with a Medicaid planning specialist in your area. Most elder law attorneys offer these consultations at no charge because they understand that families need to explore their options before making important decisions. Use this consultation to discuss your specific situation, review your documentation, and understand which protection strategies make sense for your family. Don't wait for a health crisis to force your hand. The families who successfully preserve their wealth are the ones who take action while they still have time to implement comprehensive protection strategies. Every month you delay is a month closer to losing your options completely, and the current environment makes immediate action more critical than ever before. The protection strategies we've covered today represent your family's best defense against financial devastation. With 2025 nursing home costs at $9,500 monthly and Medicaid's $2,000 asset limit, the threat to middle-class wealth has never been greater. The 5-year look-back rule means families who act today can preserve up to 100% of their assets through proper trust planning. The research cases we discussed prove this works. Families like Michael and Pamela, who implemented irrevocable trusts, saved their entire $700,000 estate while receiving quality Medicaid-covered care. Right now, assess your vulnerability by calculating your countable assets and researching local nursing home costs. Then contact an elder law attorney who specializes in Medicaid planning. With proper knowledge and decisive action, any family can protect their legacy from these devastating costs.